So the next session is role of investment bankers and exit strategies. And John from GrowthPoint is worth listening to because it was John and GrowthPoint that helped sell Green Button.
So the Green Button transaction was great fun, and working with Marcel in particular, I mean, he was a pretty extraordinary board member. And he asked me to come down here and speak a bit about the role of investment bankers. And you probably all have your own characterization of investment bankers, and I'll get into that a little bit later. But just to give you a little bit of background on what GrowthPoint's all about, we have 3 offices. Our primary office is in Silicon Valley. We're right on Sand Hill Road. And then we have an office in London and one in Sydney. About half of our transactions are cross-border. And it's generally the overseas company that's getting acquired by a U.S. company. That's more typical pattern, although we have had some intra-country transactions across Europe, and we have one that's in the works in Australia. The interesting thing about it, though, is if you look across the hundreds of transactions we've completed, about half of them have involved traditional VCs, and we're talking about some of the largest VCs in Silicon Valley, and about half have had no VCs. They've had angels, or they've just been founder-backed. And if you look at the skew of the scatter diagram in terms of where the returns have been, we've had transactions have been every bit as successful on the angel side as on the traditional venture side. So there's no magic associated with the big brand name VCs per se. Now granted, they may not be giving us their best transactions, but there's one in particular that was really satisfying to get completed. And it was a company where there was one angel, and he invested $1 million in the company for 10%, and then we sold the company for $130 million. So he got $13 million on his $1 million investment, so it's quite nice. The founders, there were 2 founders, and one of them went out and bought a boat and sailed for 3 years in the Mediterranean, and the name of the boat was No VC. So anyway, that says it all. Let's continue. So let's talk a little bit about what you might call an investment banker. And again, some of these adjectives might not be ones that you would exactly use. I've left the more colorful ones off the sheet here. But we do wear a lot of hats. I mean, in the course of a process, we start out essentially as a tactician, a coach, an advisor, and then over time, we're having to orchestrate all these different threads of conversations. We're having to actually manage both what's going on inside the company as well as what's going on with this disparate group of potential acquirers. We're having to balance what it is that they're saying, being an alter ego, to challenge some of their points of view, to challenge, is what they're saying actually accurate or reasonable? Get involved, obviously, in negotiations, and then, having to play good cop, bad cop. That's pretty typical. Ultimately, what you want, though, is somebody who's your partner, somebody you can count on, that you can speak to at any time of day, and that's somebody that, frank, you can have that frank conversation. Are we, where are things going right? What do we need to change in the course of the process? And ultimately, you're going to have times when you're going to need a psychiatrist, and we'll play that role as well. But it's at that point in time when you really have to say, what's not going right? Why do we have this particular acquirer drop out on us? Are we having problems with our particular CEO? What is it that we have to do to sort of get things back on track? Importantly, we recommend when you, as a board member, that you really want your CEO to be the chief explorer of options. You have to constantly be looking at these range of opportunities. That you can't be so single-minded focused on one outcome, because that's the biggest risk, that you end up in this place like this. Yeah, this is not where you want to end up. So it's important to really think through, particularly when you engage a banker, what's involved in terms of preparing and planning for that process, and most important, making sure that you manage the resources to ensure adequate runway. How much time does it typically take to complete an M&A transaction? It's generally about 9 months. It can be 12 months, it can be 24 months. So thinking that you have just enough money to get there and it's like 6 months or so is foolish. We had a top-tier VC on Sand Hill Road, just 2 blocks down the road from our offices, come to us about 2 months ago with a company they funded in March with $12 million. And it was an interesting idea, really brilliant founding team. They had 6 weeks of cash left. And I said, seriously? What do you expect us to do with this? Anyway, that's a challenge. So you want to sit down early, think about what all the steps are that are necessary, and make sure you have the right runway, most importantly, and then jointly go out there and attack the process. So once you decide to bring in a banker, and I can't read this behind me, but basically there's a bunch of components that are involved in the engagement letter. And typically there's an engagement fee and there's a success fee. The success fee is what keeps the banker in alignment with your objectives, because they're getting paid on a successful outcome and it's a percentage of the transaction. Beyond that, there's a lot of other components that are included in the engagement letter, including a tail period. And tail period means that you've gone into the process, you're 6 months into it, you're 12 months into it, and you might decide this isn't really going anywhere. Let's end the engagement. And at that point in time, there's a survival period on the part of for the investment bank, just to protect them to the extent that one of those discussions that was initiated early on comes back to life in that survival period, and then you get re-engaged and complete the transaction. I know it's self-serving, but I really do believe this point here, that we bring transactional expertise and so forth and actually drive better prices. There's actually market studies, and in fact, Marcel, I think you shared with me a KPMG study that also referenced another report that demonstrates the same thing. So while you may say, well, initially the success fee is quite high as a percentage of the transaction, you should expect that your banker is going to give you a premium beyond what would be your base valuation starting the process. And then the final point, when you get started with your banker, is they're not going into a black hole and just working this process as if it's a dark art. You're supposed to be engaged with them. It's something where there's back and forth on a regular basis, typically weekly. You got a project plan. You're tracking exactly what's going on with all the various candidates, who's responsible for following up with that particular candidate, and what's the next step. You know, it's something where it's like anything else, like building a house. You've got a project plan with your contractor, and it's so easy for that to get off track and cost you more money. So you hold your banker to the same, requirements. When's the right time to sell? You probably have all seen this. I mean, this is really the classic S curve. And this is where you've done your seed financing, and you're considering, do I do the next round? And when is it possible that I can have some of those discussions with a potential acquirer in advance of doing that next round, pull back some of this premium value to now, because you're basically selling on the expectation, the opportunity of what the company is going to become. And that's when the real magic happens. We've done that, in fact, with Green Button. The threat for Microsoft was that there was going to be another entity that was going to be funding into the company. And so you need to use those types of levers to help incent the acquirers oftentimes, because what they're concerned about is it's a scarcity factor. The company that you're bringing to them, there's not 20 other ones that are identical to that. It's that opportunity that they're trying to address. And if you can create that, you can realize a better value without having to suffer the dilution from the next round. Why do people sell? Now, we heard this earlier from Brian. The number one reason why you sell is to make a good return. And he's not here to defend that. But there's a bunch of other points that obviously are part of it. Obviously, you want to try to find a good home for the team. You also are recognizing that it's an opportunity to get the company away before you have to actually do the next round. So you're avoiding dilution from further investment. But in terms of the reasons why an acquirer might be interested, that's much more complex. And you really have to put yourself in the shoes of the acquirer. You have to understand what it is that's driving them to make a decision. Does your product that you've developed sell through the same type of channel that acquirer has? If you're selling products that are done over the web at $25,000 price points, and they've got a direct sales model that's $500,000 price points, they're just not going to get excited. It doesn't work in terms of fitting into their sales organization. Geography can be a driver. Key talent in terms of the engineering team. I mean, one of the key components in Green Button was the CTO. I mean, he's like a god. And that's a transaction that's worked out very, very well for Microsoft. You can obviously look in some transactions, particularly bigger transactions, eliminating a competitor, expanding a product line. Generally, it's addressing, though, for most early stage companies, excuse me, it's addressing a gap in their technology stack. If you look at most companies, are trying to establish where are their holes in their competitive landscape relative to somebody else, and how is it that your solution helps fill that requirement. And then obviously the last point is just time to market advantage. You want them to get there and be able to realize the benefit from that acquisition sooner rather than later. So this is the Gantt chart that we tend to use for managing our projects. We try not to have quite so many casualties in the process, but basically what you do is you establish a lot of parallel discussions. And if you pick any project where you're typically going to have anywhere from 30 to 80 possible candidates you're going to go to as potential acquirers, very few of them are going to survive the whole process. And what you're working towards is this one candidate. Ideally, you'd have 2 or 3 that are all jointly bidding for that opportunity. But no matter what, there's going to be a point in time which we select the finalists, and you will have learned a lot in this process. You're just hopeful that there's still one more that's going to take you across the finish line. That's the hard news. As an investment banker, where we've completed, again, hundreds of transactions, we still have a higher casualty rate than we would like. We're getting about 60% or so of our transactions done in about the first 12 months of an engagement. We still have about 20 to 30% that never get done. And then we have another 10% that just take longer than we expect to get done. So your investment banker is not a miracle worker. Don't depend on miracles. You really want to make sure that you run the best possible process, but then importantly, have that CEO and the board focused on a range of options, including fundraising, strategic partnering, all the other attributes to extend the life of the company, recognizing that that acquisition may not happen. So to go into some of the broader investment themes, this is what's probably most alarming and concerning to most people, because you have this populist wave that's rolling through some of the major economies of the world. And it's generally focused on trade issues in terms of the imbalances, in terms of what's going on there. And it's pretty alarming. So we have an office in London, and we're personally impacted because we benefit by what's called the European passport. Since we are an investment bank, we can do business in any bank across the EU without having to have separate licenses in those countries. But there's going to be a hard Brexit. That's this path here. You're not going to have this nice, easy path through the countryside. And Germany is not likely to let the UK continue to have the benefit of its financial industry unimpeded the way it's been recently. So it's going to require us, for example, to set up a second office. Probably, could be Frankfurt, could be Paris, I'm not sure where. And I have no idea what the outcome of this would be. I mean, the economic, if you look at what's going on right now with the stock market in the U.S., gold pricing and the like, everybody's quite nervous, as I am. So I may be moving here. We'll see. But despite that, and these have nothing to do with that. This is just, in general, you have situations where companies are still challenging to get done. Major brand name, Yahoo, that got flogged quite hard. And now that it has been inked, it's still being relooked at in terms of what the ultimate value is going to be. Twitter, I mean, how embarrassing is that? Put yourself up for sale, put yourself on the front page of all the business trade press, and everybody's expecting there's going to be a transaction, but it proved to be indigestible to the logical acquirers. But despite that, you got Blockbuster deals getting done, like AT&T buying Time Warner for nearly $85.4 billion. And then if you were to ask me what are the hottest sectors of investment right now, what's extraordinary right now is actually semiconductors. You've got Qualcomm, you got, there's been 3 semiconductor deals, multi-billion-dollar semiconductor deals done just in the past 2 weeks. They're all in the multi-billions and billions of dollars. So it's sort of like the oldest technology you can imagine is suddenly going through consolidation, massive scale economy. But it also suggests that these companies are bullish enough to take down massive amounts of debt, which AT&T is doing, to consummate transactions like this. Broadly, there's a whole alphabet soup of security themes or technology themes that are interesting. Here's 6 of the most interesting ones. Right now, you've got machine learning, autonomous vehicles. I mean, Silicon Valley, we've got so many cars without drivers right now. I'm not kidding. There's just on PageMail, there's another company that got funded $200 million just about 3 months ago, and their cars are going out trying to be autonomous taxi cabs. Internet of Things is red hot, virtual reality. In fact, I've heard of some discussions here about VR. Cloud, of course, is reinventing the world, and security. So of the clients we have right now in New Zealand, we have one that's machine learning, one that's IoT, we have one that's security. Actually, the one in security we're trying to land, and then we've got some others that are just more traditional SaaS-based software companies. So, you guys are hitting on pretty much all these themes. It's kind of hard to compete on autonomous vehicles in terms of the sizes checks that are being written right now. It's just massive. So timing is sometimes almost everything. And the point of this is, and I've gotten victimized by this numerous times, because you have to be an optimist. You guys are all optimists. You wouldn't be investing if you weren't an optimist. We're in the same way, because while we get paid an engagement fee to take on a transaction, that basically covers the light bill. Really it has to be successful transactions, and we're investing 9 months, 12 months of our lives into each of those deals. And so we tend sometimes to fall in love with companies too early. We get involved, particularly in our offices, we're seeing hundreds of opportunities a year, really interesting technologies and brilliant founders. And somebody's saying, I'm sure that is going to change the world. I'm going to take them on as a client. And you find out the market's not quite ready to receive that. And we have that time again. So we had a company that was an over-the-top video platform for anime content. And this was after YouTube had been created. And we started looking at it and said, well, it's a really brilliant team, all ex-Berkeley engineers. And they had a good business model in terms of how they're monetizing this content. But we couldn't get any engagement. Well, we did get Amazon interested, but they were prepared to pay like $16 million or so for it. It was really pathetic. So we put the project on ice for a bit. We rethought it. We tried to broaden the vision as to what it was they're addressing. And by the way, you need to have this conversation with your bankers. Your bankers should have that kind of fluency about what it is you're doing and where the market is, to try to think about where it should be best positioned, because it's not one flavor for all. It's a different slice of the company that might be attractive to each acquirer. And so we reset the vision. We worked on this for actually about another 6 months. Took them back to market, and we got $100 million for them. So it's just something where we had to get the right story to the right buyers, and it suddenly became strategic to them. So it just took a little bit longer than we expected. I did this just because we do a lot of work in Australia. I don't need to spend any time on that. I've been told by my friends here in New Zealand, Australia would be a great place if it just weren't for all those Australians. In New Zealand, it's a pretty remarkable angel environment that you have here. The biggest issue is that you don't have the ability to take the companies through to the next round. And I did meet this week with Richard Delabarca, and that was really interesting to actually get his perspective, to find out firsthand what his vision is. Obviously, a lot of that depends on how the government will continue to work with him, and also how the returns look across other companies in the portfolio. Ultimately, though, there does need to be a solution, or else you're going to have companies that will always be having to get sold earlier than they're really ready to. The potential here is quite significant, but you're in a captive market. While you're about the same size as Israel, you don't have the benefit of. And the thing that's unique about Israel, Israel instantly takes their companies to the United States, and they also have that whole defense government attribute that really helps drive adoption of a lot of those technologies. You look at other smaller markets like Sweden and Finland. Finland's not a whole lot bigger, but they tend to have had one big anchor company that sort of shaped the whole investment thesis. And so for Finland, it would have been Nokia. Now Nokia has obviously dramatically changed from what it was, but people that came out of Nokia that are sharp in mobile technologies created Supercell. And that's the gift that keeps on giving. I don't play any mobile games, but I'm astounded how much money they generate from those platforms. You go to Sweden, and there you had Ericsson. Then you've got others that have come along since then. Spotify, they've got a number of others that have actually done quite well. You guys have the potential. I thought that Xero would be it. Xero actually ran up really nicely, and now they've got to find a way to crack the U.S. market. Xero, it would be important for that to happen. Now, Australia had quite a success with that Atlassian, and I think that would be a real coup if there was more of that activity here, and I know that this group is all working to make that happen. There's more about Australia. There's Atlassian. The other thing that I noticed, I spoke at a conference here a couple years back, and it was about the appeal of listing on the NZX. And I saw a panel discussion with 4 companies that had all just listed that year. We used to have that in the U.S. It used to be companies would do backdoor listings through Nevada stocks, old mining stocks, or companies that might go up to Vancouver and list there. Unfortunately, most often what happens is you become part of the living dead. They become zombie companies because it's really hard when you go out there. Let's say you have a successful IPO and you raise $20 million or so. That could be the last round you ever do because you're not going to get another private investor to follow after you unless you are like a zero and you blow out so rapidly that it's such a strong growth story that it makes sense. So this is what happens in Australia. I've heard from several companies that have thinking that, well, maybe it'd be better and more accommodating to go to Australia than what's happening here. But if you look at the median performance, this is the past, I think, 2 years of all the companies that have listed, the tech companies that are down 7.8%. And you can see, in general, their performance relative to the overall Australian market is lagging quite a bit. So you're kind of in a scenario where you're not going to be able to trade out of the stock. You're trapped. I mean, I don't think I need to belabor this point for all of you. I just think this is kind of it's very expensive and it's kind of a waste of time. Global M&A trends. Have we talked about this already? I think we have in some of the earlier conversations now. Well, it remains reasonably robust. Again, I talked about the size of the checks that have been written lately for some of those Blockbuster deals. Our portfolio or our activity level is really strong right now. A lot of interesting companies, and the buyers are interested in transactions. What's interesting is the big acquirers all have tons of cash in lots of pockets around the globe, not necessarily in the U.S. So New Zealand's a very attractive market because of the quality of the engineering talent, and time zones are a little bit more accommodating here than Australia. That 2 hours really makes a difference. So I feel bullish about M&A, provided we don't have a global shutdown in trade. If you look at the median U.S. venture-backed exits just over the past, this goes back about 8 years or so, or 10 years. What's interesting right now, if you look at the median price just on M&A, it's $100 million versus the IPOs at $67 million. So we're actually even doing better on the IPO side than on the acquisition side than on the IPO. And if you consider how much money has to go into getting a ready company for an IPO, it's kind of fruitless there too. It's all software. Generally, this is just, you might want to actually look at this in the, are they getting copies of the slides? Yeah, so it's a bit of an eye chart, but you'll see, what segments are fairly active. And I wish I had New Zealand on this chart, but these are, in terms of cross-border transactions, where the active markets are. It's UK, Canada, Germany, and then Australia. And I think that's probably enough.
Okay, hey, thanks for coming down, John. And last year we had Cara here from your team, who's based in Sydney in the Queenstown conference, and you can make it for family reasons. So I hope the family reasons have been resolved, and it's great that you could make it this time.
Oh yeah, absolutely.
But in the meantime, of course, in the last 12 months, you've got to know New Zealand companies even better. So sort of natural first question is, what do you like about them? That's be question number one. And what could they do better would be question two. So what do you like about them? Why are they appealing? And secondly, what can we do better to make them more attractive and in terms of investment and acquisition interest? Right.
So what's really interesting about New Zealand companies in particular is that you have to learn how to do a lot with less. And this isn't a pejorative. I mean, it's just a reality. And if you look at the excess that takes place with a lot of Silicon Valley-based companies, when you're given a check of $10 or $20 million, you get sloppy. And you tend to take on a lot of processes and spend that isn't really productive. So, I mean, I can think of two companies in particular. This one's, and unfortunately this is an Australian company. It was very similar to the U.S. company that I've invested in personally. And the U.S. company's gone through about $10 million and is doing a fragment in terms of its activity that the Australian company is doing. And there's so much similar in terms of what their focus is. because they're hungrier. And when I look at Kiwis, they're hungrier. They're hungrier to make it happen in terms of if you're given an allocation of $1 million or maybe $2 million, which would be generous, and you have to find a way to make that spending go farther. And that just gives you a level of discipline that is lost by a lot of other companies. It's respected by acquirers. The acquirers in particular find that really compelling when they look at scenarios where the companies have actually put the investment into tangible results. What could be done better is actually getting closer to the end customers more quickly. And you just don't have enough end customers here. I mean, at the end of the day, the acquirers want to know that you can internationalize the product. And if you're doing a great job selling into New Zealand, that's not going to do it. It's got to be something they're convinced can be sold internationally. And set up an international sales organization can be really costly. So what is a good fallback, and actually more than a fallback, it should be a primary objective, is to be doing business development work from day one. Getting somebody who's focused, sometimes it's your board members who can help in that regard. But it's absolutely true that thinking through who the natural acquirers would be, but that also could be channel partners or go-to-market partners for your company, and getting engaged in that kind of process earlier is very important.
Okay, thanks, John. Any questions from the floor? Yeah.
John, one of the messages that keeps coming through is that the returns to the investors are sort of not as good as they would hope. I mean, there's an easy way to double the returns overnight, and that is to pay half as much when you buy in. In other words, the initial valuations are too high. And it seems to me that the initial valuations have crept up over the last, 10 years. Have you got any comment on initial valuations?
I think in where the valuations have really crept up have been on in the unicorn space. And unfortunately, that's skewed the whole chart up quite a bit. If you look at across Silicon Valley right now, they have flattened out quite dramatically. I think, Josh, you've seen that as well. Yeah. But for a period of time, the bigger funds, you get a Klein or Sequoia, right down the list, Andreessen Horowitz and so on, they basically were anointing certain companies to be the entity, the Uber of that particular space. And if we write enough checks to that company, it's guaranteed to be a success. And I think there's some foolishness there. Some of it is appropriate. I mean, Uber has to litigate in every market it goes into, and it needs a lot of cash. Will that be, but they're still going to have some competitive issues. But when you strip out those companies and go look at the space down below that, I think it's a more rational pricing environment now. Now, the issue that's unique to Silicon Valley that you don't have here is that there's a real cost imbalance. And Josh, I'm sure you've seen this firsthand. It's like expensive rent, expensive talent, expensive housing for engineers you want to attract, dreadful traffic. I mean, it's not a good work environment. So people are starting to look at other venues like Portland as being a better spot to locate companies than in the Bay Area because it's just too competitive and it's just, I'm not sure if it's frothy. I don't know if there's going to be a crash, but it's, do you have anything to add to that? Yeah.
Everyone talks about how it's cheaper to do a startup. You always hear that, and that's not true anymore. It really isn't cheaper to do a startup, especially now, because engineers are $120,000 to $150,000. Rent is ridiculous. There isn't really a good mass transit system, and so you have to pay more for everything. So it's not really that cheap. To get the computers cheap, to get the Amazon Web Services, stuff like that, and otherwise it's pretty expensive, and a lot of talent is staying put. They're not moving as fast as they once were. So it's just expensive, and so companies have to raise capital, and if they're priced too high, they won't raise the capital. The other interesting thing is more venture capital has been raised in the last 2 years than ever before. There's lots of venture capital money available, but we're taking our time. We have to do it. Just one more anecdote for the Ubers of the world and Airbnbs and stuff like that. It's a safe place for large venture capital firms, these firms that have $500 million or $1 billion or the sovereign wealth firms, to put their money in, because if they get that liquidation preference, they're guaranteed to get their money back. So if they have to deploy that capital, they'll do so into the sure bets, no matter what. And that is skewing stuff up. Right? But the reality is, on the ground, we're seeing good competitive prices.
An example of that, if you look specifically at the investment in travel and technology startups just in the last quarter, it's skewed because $850 million went into Airbnb. So if you strip that out, the average investment was actually relatively modest. It wasn't a step up. In fact, it was actually a decline. But there's such a large check written on that one investment that it just threw all the numbers out of whack. The only other point I'd make about, do you do half the size of the investment? Well, then you've got, in my mind, half the probability that it's ever going to be a success. I mean, the fact is there's an amount of money that you've defined to make that company successful. And either you believe that or you don't. And then the valuation has to also be factored into that. But cutting back the investment means you just don't do the investment. Yeah.
So, John, as companies look at engaging an investment banker, could you talk a little bit more about the different profiles of bankers? They're clearly sector specialisation. There might be a different orientation that different banks take. It gives a sense of the investment banker community that our companies would look at in terms of determining who's the right fit for their company.
So obviously you could take a pyramid. At the apex, you've got the major brands, Goldman and so forth. And down at the bottom, you got a whole herd of boutiques, and we're one of those. So we're a scrappy firm in Silicon Valley, and we've been doing technology banking for over 20 years. So, we really know this. I've been doing it for over 30 years. So it's something where there's a domain expertise, and there's probably, there may be 20 firms like ours, actually, that are focused on technology. And some of them have offices in London, like we do. Others are in other geographies. What's unique about smaller firms in contrast to larger firms is oftentimes larger firms, you're going to engage the MD or the partner and never see that person again because you're going to get handed off to an associate or maybe even somebody more junior. And the reason why I'm in the business and the reason why my partners are in the business is because we enjoy the technology. We enjoy working with our companies and with the founders. But not all firms are like that. So it's one where you really speak to some of their other clients and get a sense for what was it like to work with that banker. Did they stay with it through the whole process? Did that person disappear after the first meeting and not be there any longer? Also at the pinnacle, or even dropping down from that, a lot of firms are focused on IPOs and public offerings because that's a much more lucrative business. It can be when there's an IPO market. But they have the whole trading organization they have to preserve and the costs associated with that. We didn't do any of that. Our focus is strictly M&A, and we do strategic partnering and occasionally, late-stage capital raising. And a lot of firms have different flavors as to what it is that they do. And we have a league table that we will include in some of our marketing slides, which shows that we deliver the highest multiple to revenues of any investment bank around the world. But then again, we're tending to deal with smaller transactions. they're typically like 30 million to 100 million. We're not dealing with the multi-billion-dollar transactions that, Catalyst or Morgan Stanley or somebody like that might be representing. So very different.
Do businesses get bought or sold?
It's actually a little bit of both. It's mostly getting bought because it's hard to force an acquirer to suddenly put you on their short list of targets that they want to go after. But there are occasions when acquirers have a blind spot and they didn't even realize that this opportunity existed. So you can't rely upon just word of mouth and PR and the like to help develop companies that are going to come knocking on your door. You have to actually open the door and make sure they're aware of what you're doing. Now, that's part of the role of the business development person, too, because to the extent that you can actually create that joint market dynamic to the point where there's that proof of concept and they're ready to embrace that entity as part of their stack going forward, it makes it more logical that they'll acquire the company.
Questions? Any more? Yeah, Suze?
I was wondering how much of your business comes from angel-backed companies. What's the proportion? And is it a different kind of are there any kind of characteristics of selling angel-backed companies that differ from some of the other business that you do?
Yeah, it's probably in the neighborhood of about 30 to 40%. I mean, it's a really good question because we categorize where our clients come from in terms of what their referral source has been and the like, and the highest number in general are VC-backed, traditional VC-backed, but that's about 50%. And so the rest are, from angel-backed or just founders that have not taken any outside capital. The angel-backed companies, the risk that we run is they don't have sufficient capital to run a project. And if they don't have that support, we won't take them on. And we insist that there be at least 1 year of capital there. And that can be a road or bridge too far for a number of investors. The other issue for angel-backed companies is we want to make sure that it has a board that actually can contribute to the process. So you're not just dealing with the CEO, but you've got basically a team of people that you can work with and collaborate with as you're trying to work through different outcomes. And that's really important. And one of the worst experiences I ever had was an angel-backed company where this is probably one of the most prominent angel groups in Silicon Valley. And I mean, this guy, he knows his stuff. But we had a buyer fly in. It was a multi-billion-dollar company. And we were having a dinner meeting, and it was a great meeting. And at the end of the meeting, this board member says to the buyer, well, this is great. We have another buyer coming in tomorrow, and we got to see what happens there. We got to make sure all the shoes have dropped. That was it. Those guys left, never came back, and the other buyer never bid. So yeah, you just got to make sure everything's well scripted and everybody knows what their role is, and nobody goes outside those boundaries, and you're generally pretty good.
Don't fuck it up, right?
Yeah.
Hey, look, thanks, John. And then I just should point out that John's offering a volume discount to New Zealand companies exiting via GrowthPoint. So
it's got to have the right wine associated with it.
Yeah. So thanks again, John.
Yeah.
Cheers.